In recent economic news, traders are increasingly betting on a softer approach from the Federal Reserve due to emerging signs of a slowdown in the job growth. This shift in expectations was catalyzed by the latest employment data, where gold prices saw a significant rally, buoyed by the weaker than expected payroll figures and declining Treasury yields. Fomc news was the latest news for us today. Yesterday we had also some major red folders, so we have some key points. The Fed will be cautious on further easing. Inflation will be harder to predict with the new administration policies, and a slow of the rate cuts will be anticipated for the 2025 year. So our factual bias based on current data will be positive for USA. The ISM Services PMI and JOLTS jobs opening data indicates ongoing economic activity and a tight labor market, which could lead to expectations of sustained or even tighter monetary policy to manage inflation, generally supporting the USD. Lower unemployment claims suggest economic stability or growth, which is favorable for the currency. Fed projections included slightly lower GDP growth and a bit higher unemployment rate, potentially supporting a stronger USD if interpreted as a cautious approach to monetary policy easing. Neutral to slightly negative for the USD. The ADP unemployment change below expectations might suggest a cautious approach by businesses, potentially hinting at concerns over future economic conditions or policy impacts, which could temper USD strength if interpreted as a sign of slowing growth. Dovish comments from Fed officials like Walker could support expectations of rate cuts, which might weaken the USD. Uncertain impact. Fomc minutes. The Fomc minutes could sway market sentiment significantly. If they suggest a more hawkish Fed, this could lead to USD appreciation due to anticipation of higher interest rates or a slower pace of rate cuts. Conversely, dovish minutes might weaken the USD if they imply concern about growth or a more accommodative policy stance. Quick bias. For the dollar. Slightly strong, the current data leans towards supporting the USD with strong service sector indicators and low unemployment claims. However, the anticipation around the Fomc minutes introduces uncertainty, with a potential for either strengthening or weakening the USD based on the policy tone. Also, we need to consider Trump is very vocal and it's talking a lot. So, as an extra factor, I have this news release that Trump is considering a national economic emergency declaration to allow for a new tariff program. This is red news and very negative for the dollar at short and mid-term. Xauusd bias. At the moment will be neutral to slightly weak. Gold typically benefits from economic uncertainty or dovish monetary policy expectations. The current mixed signals from employment data keep gold prices stable, but stronger USD expectations from hawkish Fomc minutes could exert downward pressure on gold. However, if the Fomc minutes lean dovish, gold could see a bullish reaction. Overall, the data presents a mixed but generally supportive outlook for the USD, with services sector growth and robust job openings being counterbalanced by a slight disappointment in private sector job growth. The Fomc minutes remain a pivotal factor in determining the immediate direction of both. So moving to what makes money and is the market, okay? So we continue with the same structure. Let's go to this chart. As you can see, market just opened after we had the news release of today, and the market was also waiting for the Fomc minutes. So we have this big pressure after the elections and the rates reduction of December, and now we are currently in what seems to be a minor cycle, a bullish minor cycle, because we are not able to break these zones. I'm marking these yellow zones as the current range because the reaction to the triple top, and now it's a quadruple top, we could say, in the 2 hour. If we go to the 4 hour, we will have it more clear. These reactions at this area are huge. Let me show you the 2 hour candle. This reaction by this candle, it's similar to yesterday. It's a lot of volume. It's showing that price doesn't want to move higher yet, but it's also chasing this other area as a liquidity booster. So once we touch this area, if we go there, price can just go wild, and it could go both sides. Currently, as mentioned in the technical, in the fundamental aspects, economy is showing, even though it's combined, it's showing more strength for the dollar. So the idea is that those candles are really the market tendency or the cycle that the market wants to take, but also at the same time all the extra information like Trump, Musk, and the Federal Reserve showing not interested in reducing rates this year is taking what we could say some indecision in the market. So big players are kind of playing their cards slowly because you don't want to get caught in the middle of a new cycle, and especially you don't want to buy gold when it's near the all-time highs if it's going down. Okay, so the yields are also another main factor. It's going up, so the price is going up or the yield is going up, so that can be also attractive long term and also short term, because at the end you're buying a price of gold that it's very expensive, so that your potential for win, it's only if we have another economic cycle of uncertainty or against the US dollar. If it's not like that, if it's not a worst case scenario, it's very hard that your investment with gold at this price takes a good amount of return, because not everyone uses leverage like forex traders. Not everyone has our skills of trading, so they need to wait for price to go from 2000 to 3000 so they can make a good profit. Okay, so from here to the all-time high, it's really a very small profit for them, so they need to wait for higher prices. So I would like to say, even if the price of dollar gets punished, they need to get at least a lower leg, we could say, to buy at better prices, and only institutions and big banks can push the price to those lower legs that we are aiming at, this at least price at 25.84. But the reality is we have tons of liquidity in other areas, like in the 24.93 and here in this spike at 25.35, where price can easily go to get more pressure to the upside. Sorry. So as mentioned, the technicals just show that we are currently in a cycle that seems to be short-term bullish, but also tons of indecisions because we cannot break this area where we have tons of liquidity. The idea for now is wait to every data that or extra news like Trump talking or saying whatever he says is gasoline or diesel. So is diesel for the market. So we need to stay ahead of the news and every event by positioning ourselves smart. So we consider right now that we are in the middle of a trend or in the middle of the beginning of a trend. So try to position yourself small or stay away until you start watching for candles like this. We need to see liquidity or real pressure entering the market. So this type of candles or sustained trends. This is not a sustained trend because, as you can see, every major push we managed to get at least the 50% of a bearish candle. So the pressure over the bullish or the pressure of bears over the bulls is currently ahead or equal. So even though we have this sustained micro bullish trend, price is ranging overall in macro. So unless you are scalping and gambling the 1 second chart, you are controlling the situation by assuming we are currently ranging and chilling. Just chill and mark your charts, stay ahead of events, and don't take big positions unless you know the risk. Have a good one, Gis.